Okay, let's unpack this. Today, we're diving deep into MPLX LP. They're a major player in the energy sector. We're looking at their recent financial results and strategic moves for the second quarter of 2025. And to get this clear picture for you, we've pulled insights straight from the source, MPLX LP's official Form 10Q filed with the SEC, and also their news release from August 5th. Our mission, really just to cut through the noise, extract the most important nuggets of knowledge, give you a shortcut to being well-informed about a company that, well, fuels a significant part of our economy. This isn't just about the numbers, right? It's about understanding the why behind them and what it all means for the future of energy infrastructure. So let's start with the big picture, the financial currents and how they flow for MPLX LP. They're a diversified, large-cap master limited partnership, an MLP, formed by Marathon Petroleum Corporation, MPC, and essentially they own and operate that crucial midstream infrastructure, the stuff that moves energy. Think pipelines, processing plants, storage facilities, that kind of thing. Their business is primarily split into two main segments. You've got crude oil and products logistics, and then natural gas and NGL services. Now, when we look at the top-line financials for Q2 2025 compared to Q2 2024, what's really intriguing right off the bat is a slight decrease in net income attributable to MPLX LP. It came in at $1,048 million this quarter.
Which is down from $11,176 million last year.
Right. But here's where it gets interesting. Adjusted EBITDA attributable to MPLX LP actually grew.
Yeah, that's a key metric.
It hit $1,690 million in Q2 2025, up from $1,653 million. This growth in EBITDA, it really emphasizes the company's stated focus on, executing its value chain growth strategy.
Absolutely. Shows operational strength.
What's also pretty impressive is the increase in net cash provided by operating activities.
Yeah.
That rose substantially, $1,736 million in Q2 2025.
Up from $1,565 million in Q2 2024. That's strong operational cash generation.
Definitely. And when we look at distributable cash flow, DCF.
Which is super important for MLPs, tells you what's available for payouts.
Exactly. It reached $1,420 million in Q2 2025.
Just slightly up from $4,004 million in the prior year, but still up. This divergence between the dip in net income and the strong growth in adjusted EBITDA and cash flow. It's a critical takeaway. It fundamentally tells us that while some non-cash stuff, maybe accounting adjustments or perhaps a one-time gain last year, might have hit net income, the operational engine of MPLX is not just healthy, it's actually improving its cash-generating power.
That makes sense.
And for you, the listener, it highlights that sometimes looking just at net income. It can obscure the real picture, the company's true financial vitality, its ability to generate cash for operations, growth, and those investor payouts.
That's a really crucial distinction to make. And speaking of payouts, MPLX LP announced their Q2 2025 distribution, 0.9565 per common unit.
And their distribution coverage for the quarter was 1.5x.
1.5x, okay.
Which means they're generating 1.5 times the cash they need to cover those distributions.
So pretty healthy.
Very healthy. It's a slight dip from 1.6x in Q2 2024, but 1.5x. That's still a strong indicator of sustainability. Shows they've got ample cash to cover payouts and retain capital for growth.
Good point. And their leverage.
Leverage ratio, yeah. It improved, went from 3.4x down to 3.1x.
Oh, wow.
It's well within their target range. They aim for under 4.0x. So it signals a very strong, pretty conservative financial position.
Okay, so with that financial overview, how are these currents actually shaping MPLX's strategy on the ground? Let's dissect their two main engines, crude oil and products logistics, and natural gas and NGL services. Each segment tells a kind of fascinating story about how they're navigating the market to drive growth. Let's start with crude oil and products logistics. This area showed a really positive trajectory. Adjusted EBITDA increased by $39 million.
Up to $1,138 million in Q2 2025. Solid growth there.
Yeah, and the drivers behind it are quite clear. A big chunk, $45 million, came from rate increases. They're just getting more for their services.
Makes sense. Pricing power.
Then another $6 million from increased pipeline throughput. Their total pipelines are moving over 6,100,000 barrels per day now.
Huge volumes.
And don't forget the $5 million from additional marine equipment. They added barges and towboats.
Right, expanding their fleet to 320 barges and 29 towboats. More capacity.
Exactly, expanding capacity.
So if we connect this to the bigger picture, while there were some headwinds, like lower income from some investments and higher operating costs, the segment's core operations are clearly benefiting from those strategic rate adjustments and the increased volumes.
Yeah.
It really demonstrates how effective management of existing assets, just optimizing what you have, can truly drive growth. Even in a complex, kind of mature market, it's not always about building brand new stuff.
Absolutely. Maximizing what you've got. Okay, now let's shift gears. Let's talk natural gas and NGL services. Here, we saw a slight decrease in adjusted EBITDA, down $2 million.
Bringing it to $552 million in Q2 2025.
Right.
But what really stands out when you look closer, the prior year's numbers included a significant one-time gain. Remember that $151 million gain from the Whistler joint venture transaction?
Ah, right. That explains a lot.
Exactly. So without that unique boost from last year, this segment actually shows underlying growth. That growth was largely driven by a pretty impressive $78 million increase in NGL sales volumes. Wow. Particularly in the Southwest and the Marcellus regions.
Even with lower prices in some areas.
Even though NGL prices were lower in some areas, yeah. So despite price headwinds, the volume was strong.
Okay.
But this underlying growth was somewhat offset by challenges, like $19 million in higher operating costs, $10 million in higher project spending, and $11 million lower volumes in the Bakken and Rockies regions.
Got it. So a bit of a mixed bag, but underlying strength when you factor out the one-timer.
Precisely. And just to give you a sense of the scale here, their total natural gas gathering throughput was over 6,500 million cubic feet per day.
Huge numbers.
Nearly 9,750 MXT processed, and over 630,000 barrels per day of C2 plus NGLs fractionated. That's just from the MPLX LP operated assets in Q2 2025. Massive volumes underpinning their fee-based revenue.
Okay, here's where it gets really interesting, I think. The strategic updates. MPLX isn't just managing what they have, they're actively shaping their future. So what's on the horizon for them? Well, they recently announced a definitive agreement to acquire Northwind Midstream.
Big move.
Huge move. $2.375 billion in cash, expected to close in Q3 2025.
And strategically vital, right? Enhances their Permian position.
Totally. It deeply enhances their Permian natural gas and NGL value chain. Northwind specializes in sour gas gathering, treating, and processing services. That's in Lea County, New Mexico.
And sour gas isn't just a name, it contains hydrogen sulfide.
Right. Corrosive stuff. It has to be removed before the gas can be used or transported safely.
So that makes sour gas treating a specialized, valuable service.
Definitely. And Northwind brings a lot to the table. Over 200,000 dedicated acres, more than 200 miles of gathering pipelines, 2 in-service acid gas injection wells.
With a third already permitted.
Yeah, and 440 million cubic feet per day of sour gas treating capacity, expected fully online by the second half of 2026.
And the financial impact.
Expected to be immediately accretive to distributable cash flow.
Meaning it boosts cash available for distributions right away.
Exactly. And it's supported by minimum volume commitments from top Delaware Basin producers.
Which helps ensure stable, predictable revenue, reduces risk.
Good point. So beyond acquisitions, MPLX is also building out an impressive pipeline of organic growth projects. Think of it like a multifaceted approach to meeting future energy demand.
Right, not just buying, but building too.
First, on the processing side, they're significantly boosting Permian processing capacity. Plants like Secretariat, that's a 200 million cubic feet per day facility, expected by the end of 2025.
Which brings their Permian processing capacity up to 1.4 billion cubic feet per day.
BCFD. Right.
Then in the Northeast, Harmon Creek III, that's a 300 MNFD processing plant and a 40,000 barrels per day deethanizer. Big project.
Increases Northeast processing to over 8 BCFD and fractionation up to 800,000 barrels per day by H2 2026. These aren't just numbers, they represent massive additions to their ability to process and prepare natural gas for market.
Absolutely critical infrastructure.
Then there are the pipelines, the arteries of the energy system. MPLX acquired the remaining 55% interest in the Bangjul pipeline back in July 2025.
For about $700 million, plus an earnout.
Right, and this is expected to lead to a significant gain, maybe over $400 million, in Q3 2025.
Wow, okay.
And the Bangjul pipeline itself, it's expanding from 250 to 300,000 barrels per day, expected H2 2026.
More capacity coming online.
Yep. And 2 other major pipelines, Blackcomb and Rio Bravo, designed to transport natural gas from the Permian to the Gulf Coast.
Big capacity pipes, up to 2.5 BCFD for Blackcomb, 4.5 BCFD for Rio Bravo.
Exactly. Both slated for the second half of 2026. And then there's a Traverse pipeline, bidirectional, 2.5 BCFD.
Offers crucial optionality between Agua Dulce and Katy, expected 2027.
Yeah, these are really big picture projects connecting major supply areas to key demand hubs.
Definitely laying the groundwork for future flows.
And finally, MPLX is extending its reach even further down the value chain. 250,000 barrels per day. Gulf Coast fractionators are planned for Galveston Bay.
2028 and 2029 in-service dates.
Correct. And their sponsor, MPC, is purchasing the offtake.
Guarantees a customer, essentially.
Right. And a 400,000 barrels per day LPG export terminal. That's a strategic partnership with Onio, Inc., anticipated in 2028.
So really expanding into exports as well.
Yeah, it really speaks to their long-term vision.
You know, this robust and diverse project pipeline, it truly raises an important question. How will these significant investments align with, say, the accelerating demand for natural gas, particularly for electricity generation, including, the surging needs of data centers, which we see highlighted in the broader economic outlook?
That's a great point.
MPLX is clearly positioning itself to meet these evolving energy needs well into the future.
It certainly looks that way. And they're also expanding crude oil and products gathering pipelines, too, in the Permian and Bakken basins. So it's part of their crude oil and products logistics segment growth, too. A comprehensive strategy.
Definitely covering their bases.
Okay, let's transition to MPLX's financial strength and how they're allocating their capital. Their liquidity position looks quite robust, totaled $4.9 billion at June 30, 2025.
That's solid cushion.
It includes $1.4 billion in cash, $2.0 billion available on its bank revolving credit facility, and $1.5 billion available from that intercompany loan agreement with MPC.
Gives them flexibility.
For sure. In terms of debt activity, they recently repaid $1.2 billion in senior notes back in April and issued $2.9 billion in new senior notes in March, sort of refinancing and managing maturities.
Standard practice. And they intend to use debt financing for those recent deals, right?
Yes, to restore liquidity after using cash for the Bang Deal acquisition and to fund the announced Northwind midstream purchase.
Okay. And a critical point here is that MPLX maintains investment-grade credit ratings.
Right, from Fitch, Moody's, S&P, all BBB or equivalent stable outlooks.
That's a strong endorsement of their financial management, and it provides crucial flexibility in a capital-intensive industry like midstream energy.
Oh, so?
Well, it allows them to finance these large-scale growth projects efficiently, at favorable rates, which is a significant competitive advantage. Cheaper capital.
That makes sense. That financial flexibility is definitely key to funding such ambitious growth, and they're clearly committed to returning capital to unit holders. $1.076 billion returned in Q2 2025 alone.
Wow, that's substantial, through distributions and unit repurchases.
Exactly. They repurchased $100 million in units in Q2. And just recently, August 5th, they announced an incremental $1.0 billion unit repurchase authorization.
On top of what was already remaining.
Yeah, on top of the $320 million remaining from the previous authorization.
That signals strong confidence, doesn't it, in their future cash flow, and probably a belief that their units are undervalued.
You'd think so. It's a significant commitment. Finally, we can't overlook their foundational relationship with MPC, Marathon Petroleum Corporation.
Big sponsor relationship.
Right. MPC isn't just the sponsor, they're also a major customer. This relationship is really significant. MPC accounts for, roughly 48–50% of MPLX's total revenues?
And about 26–27% of its total costs and expenses.
Yeah.
So deeply integrated.
Very.
And if we connect this to the bigger picture again, the stability provided by these long-term, fee-based commercial agreements with MPC, it's crucial for MPLX.
Like an anchor.
Exactly, like having a consistent anchor in a sometimes choppy sea. This relationship largely insulates MPLX from, temporary market volatility. And it helps underpin that consistent cash flow that supports the distributions and those large-scale growth projects we've been discussing.
Makes perfect sense. Okay, so to summarize our deep dive here, MPLX LP is strategically expanding its energy infrastructure, especially in the natural gas and NGL space. It's all backed by rock-solid financial performance and a clear, strong commitment to returning capital to unit holders.
Seems like it.
Their recent acquisition, Northwind, and that robust project pipeline show a company actively shaping its future, positioning itself for long-term growth in what's definitely a dynamic energy landscape.
And as we look at MPLX's robust project pipeline and that increasing focus on natural gas infrastructure, it really raises an important question for you, the listener, to consider. How might the global energy transition, particularly the growing demand for natural gas in new sectors like data centers and maybe increased LNG exports, how might that shape the long-term value and strategic direction of midstream companies like MPLX? What other shifts might they need to navigate in the coming decades?
It's definitely something to ponder. The energy landscape is always evolving, isn't it?
Always.
And understanding how companies like MPLX are adapting and growing within it is critical if you want to stay well informed. So Keep learning, keep asking questions, and we'll see you on the next deep dive.